Okay, so I hope you've had a chance to, let me just get that there, to go through the Income Tax Act, look at your assignments, spend a little time with this. And I want to go through just some details about how I want you to think about it and issues that you might want to consider when we talk about measuring business income. So one of the first things I want to talk about is we've discussed business versus property versus employment versus capital gain and whatnot. But what about business versus personal? We haven't actually addressed that. I.e., what if what you're doing or the taxpayer is doing is actually a hobby? Maybe they're in art, maybe they're in music, maybe they're raising horses. I mean, this see wealthy people do things like start a horse stable and they raise horses, they race horses, and so forth and so on. And the question is the issue of deductions. Generally speaking, if whatever the activity is, it gives rise to net income. So if there is net income, the income is going to be taxed. There's going to be assumed to be a profit motive, and therefore under Section 9, the profit. The question is, what if there isn't income? What if what we've got basically is instead of net income, we have a net loss? Are those losses business losses, or are they from a hobby, from something personal that is not in fact ever really going to make any money? And essentially you and I as taxpayers are subsidizing somebody else's hobby. All right. And so what we look at is there has to be a reasonable expectation of profit. The law says, okay, for us to be able as taxpayers to take these deductions and to deduct any net losses, there has to be a reasonable oh, I didn't spell that right, did I? Expectation. There we go. Of profit. It doesn't have to be profit in any particular year. Small businesses, startup businesses frequently generate losses in early years. You've got a lot of costs connected with getting a business up and running. So we allow for that. The government, the tax system is structured so that that's acceptable. But at some point, the idea is that maybe the business, if it's a business, should actually make some money. And that's where this reasonable expectation of profit comes from. So that's one of the things that we do want to think about. Generally, we have wealthy clients. I mean, one example also might be gambling. Generally speaking, the assumption is that there's no reasonable expectation of profit with gambling, and you can't deduct gambling losses against employment income, other business income or property income and so forth, unless you can demonstrate that you're really good at it and you have some reasonable expectation that you could make money at this. All right. Another thing we want to mention is barter transactions. They're treated like any other activity. Fair market value of the service or the product. If I, as a tax person, trade with my dentist does teeth for me and I do tax returns for him, it's income to either one of us. My services, I have income equal to the value of his services and vice versa. Damages, another thing that we might think about, and this is very similar to what we saw with the accident insurance, health and accident insurance with employees. The question is typically are payments for damages income or capital on income or capital, and it's going to be the nature of the damages. If it's replacing something, putting the entity back into the position they started from, that's a capital type thing. Remember we talked about if so you get a lump sum because you lost a leg, something of that nature, versus replacing income. So it's the nature of the transaction, the damages. If it's replacing income, there was a contract that wasn't fulfilled, something of that nature, then it would be related to income. So it's very similar to the pattern we saw with accident health for employees. Because again, the logic is there. The makes sense is there. In terms of deductions, again, Section 18, you've got to have an income source where the deduction contributes to it. We have to find a way in. As we said, the government wants all your money. So to get a deduction, we need to have some logic that allows for it, and that would be things like generating income. Can't have anything personal. We saw that in the one provision. Reserves, very restrictive. Now, as I mentioned, I want to go through the account receivable reserve with you. You'll recall I mentioned in the lecture we just did about using the Income Tax Act for business income that most businesses are concerned with the measurement of the income statement and use percent of sales to measure bad debts. Normally, if we were in the classroom, I would be asking you guys all kinds of questions about how to account for bad debts and freaking you out. But sigh, we're not in the classroom, so I have to do it myself and not get to give you guys a hard time. So we use percent of sales to measure bad debts, most businesses, because they're concerned with matching. They want to match costs with revenues. And so the period that the revenue is generated, they'll look at the revenues. So we're looking at a income statement account, revenues, and we get an income statement number. We get the bad debt expense, right? And that's the matching system. The tax law requires the aging system. You're not allowed to use percent of sales. You must use the aging technique. And that's where we review the accounts receivable and we arrive at the uncollectible receivables. So the uncollectible amount, and that is the allowance for doubtful accounts. So we evaluate a balance sheet number and we get a balance sheet number. So that's how we deal with the accounts receivable for tax. So if we look at the way it's actually done, remember that for accounting purposes, you have this financial statement net income of whatever amount. And in this number, that number includes the bad debt expense deducted by the company. Right? So the first thing we have to do is get rid of it. Because we're going to use the tax number. So we have to get rid of the company number. So essentially what we do is step one, we add back the accounting bad debt expense. All right. So if the bad debt, if we have, say, a beginning balance in the allowance account of, say, 12,000. All right. And the company bad debt expense was 3,000. We will add that back. And that basically takes us back to zero. We've taken the bad debt expense out of the financial statement net income number, and we're back to zero. If for the aging, on an aging, we determine that the ending balance in the allowance for doubtful accounts should be, say, 16,000. All right. That's the number that we assume is we don't assume, but is been calculated doing an aging that the ending balance should be in the allowance for doubtful accounts. So to get, that means that we should be deducting a bad debt expense here of 4,000. Well, we don't actually do that. And while yes, you could do it, you could do this on a net basis, don't. It's not what the law says. The law says to Section 12, you include the beginning. Section 20, you deduct the ending. Do what the law says. And in fact, I would suggest even if the company is doing an aging method, just get used to add back the company bad debt. that eliminates it. We're at basically a bad debt of 0. Then step 2, we add back the allowance for doubtful accounts the AFDA beginning balance. So we'll add back 12,000. All right. Then step 3, we subtract the allowance for doubtful accounts ending balance. That's 16,000. What that does, of course, is give us the 4,000 bad debt expense. So under the tax system, the bad debt expense is actually higher than it was using an aging method. It can go either way. That part is just depends on the economics of the particular situation in a particular year. But notice that the taking the add back at the beginning and the subtract at the ending will give you a bad debt. It's conceivable that the beginning is higher than the ending if something has changed. Well, it doesn't matter. That'll just give you what amounts to a bad debt recovery, which is what it should be. So that's how you do it. I strongly recommend when you do your problems that you always do these 3 steps. It's what the law requires, and it makes it less likely you'll do a mistake if you try to do some kind of netting and say that it's $1,000 bad debt expense. All right. I mentioned that inventory has to be on the lower of cost or market valuation method. All right, so make sure that you are aware of that, and it has to beginning inventory, has to equal last year's ending inventory, things of that nature. LIFO is not permitted for tax purposes. It's not common in Canada for accounting purposes, but in any case, it is not permitted for tax purposes. And deductions that were not permitted, I think I've looked at a number of them. We talked about section 19. I've listed some on the slides, exempt income. Oh, we're not allowed, no dues for recreational facilities. So golf club dues are not deductible. Prepaids are accrual basis, so there's typically the deductions for prepaid items would be the same as accounting. Okay. We talked about CCA being something that we will get the capital cost of assets. We'll look at the CCA when we do the chapter on CCA. Financing costs, typically over 5 years. You can look at section 20 sub 1E. Landscaping is deductible. It might appear to be a capital cost, but it is deductible under section 20 sub 1 double A. There's other limits that you'll look at later in your tax education, but those I think are the main limits that we look at for our purposes. There's others that may come up in the problems, and certainly as we go through the problems and as I look at the problems with you as other deductions show up, we'll talk about those. But for now, I think everything else that we might want to see, you'll see in your problems.